Today I would like to talk about the shock propagation across international equity markets. And this is a joint work with Dion Bonhart, Richard Roll, Dominic Roche, and Matthijs van Dijk. The chairman of the session told that this paper will not be about India, but it's not actually very true because Indian market is one of the 12 markets that we are looking at. So what motivates us to write this paper? Well, first, during past decades, we observed that the globalization process, we observed an increased globalization in the world, and now we know that the shocks can spread globally and that they can spread very rapidly. In the light of recent financial crisis, we also know that it's extremely important to look not only at shocks to prices, but also at shocks to liquidity. For instance, this paper by Brunner, Meyer, and Pedersen, which describes the liquidity spirals, which suggests that first the shocks come to funding liquidity, then it spread to market liquidity, which results in drops in prices. But we still don't know little about how exactly extreme returns are propagated across different markets. We don't know actually what happens with liquidity around shock to price on average, or what happens with trading activity around shock to price. And nowadays, if we want really to track the propagation of shocks through financial system, we have to go to a higher frequency. We have to look at the intraday data, but not at the daily data or something like that. So the previous work links coincidence of extreme returns to financial and macroeconomic variables, such as interest rates or exchange rates. What we want to do, we want to focus specifically at returns, liquidity, and trading activity, and try to link all these three shocks together and see how quickly they get transmitted from one market to another. So we view the main contribution of our paper as follows. First, we think, and I hope I will be able to convince you that shocks to prices are the result of the information incorporation rather than low liquidity on some irrational behavior of the public, like panic or something like that. Second point is that we do believe that liquidity black holes are very rare and they are local. So basically the mechanism of the recent crisis, when liquidity evaporates suddenly and lead to drop in prices, was actually very local and very rare event. In this sense, it didn't get transmitted to any other markets. Shocks, the last point is, I guess, a bit not surprising, given the advances in algorithmic trading. Nowadays, what we show is that shocks to prices and trading activity are propagated across markets at the same 5-minute interval. While, as I mentioned before, shocks to liquidity remains on the market where they originated. So let me now describe the data sets that we are using. We look at tick-by-tick data on trades and quotes provided by Thomson Reuters Tick History. We cover the period from 1996 to 2011, and we look at 12 different countries. We group them into 3 regions by the time zone, basically. Asian region includes Japan, Hong Kong, India, and Malaysia. American region is Brazil, Canada, Mexico, and United States. And European African region is France, Germany, South Africa, and United Kingdom. So in total, we have in our sample around 5 billion of trades and much more quotes, especially in the recent years. We aggregated our data at the 5-minute frequency. What we also do, we don't look at each stock individually, but we aggregated everything to a market level. And we look at the stocks that were ever part of the major index during this period. We look at the following variables: returns, liquidity as measured by proportional quoted spread and proportional effective spread. Well, the first one is just the difference between quoted bid and ask prices relative to the midpoint, and the effective spread is the difference between the trade price and the midpoint. And we have 2 proxies for trading activity. We measure it by turnover and order imbalance. So how do we measure the shocks? Well, there are a lot of different methodologies of how you define what is an extreme event in the market. In this particular case, we decided to look at the jump measures. We took a Barnett-Nielsen and Shepard jump measure. The underlying idea of this approach is that, in theory, we think that intraday returns have zero drift and some diffusion, Brownian motion with some diffusion. But plus, in addition to it, you also have a Poisson process with generated jumps. So the underlying idea of this measure would be to compare a continuous variation of the process, which is only the variation of the Brownian motion, which is called bipolar variation, to a total variation, which includes jumps, which is a regular squared variation. If the ratio of these two is close to 1, then you can say that there was no jump in the time series. If it's far away from 1, then there was a jump. So in this particular case, you can see on the graph actual return series on 2nd of September 2011 at London Stock Exchange, which has clearly an outlier at 1045. If you compute our statistics, then you can see that the continuous variation of the process is much smaller than the squared variation of the process, and it's only 0.27. The ratio of this is only 0.27, which is significantly different from 1. So what we can conclude from this statistic is, indeed, there was a jump during that day. But what we want to do, we want to go a bit further. And we develop, in addition, an algorithm that would pinpoint the exact time interval when the jump occurred. Basically, what we do, we recursively go through all the data points during the day, and we throw away each of them and try to see whether our jump statistics is affected or not, and then choose the ones that has the most impact. So just to compare, you can see the same day, but assume that at 10:45, instead of a jump, you would have a 0 return. And what you would have is that the ratio of two variations is 0.94, with a p-value of 0.2. You can conclude that there was no jump on that day. Let's go to some summary statistics. So here on the graph, you can see a number of 5-minute intervals with jumps for positive and negative jumps grouped by region, with red one is for America, blue for Asia, and green for Europe, Africa region. What you can see from this graph is that, first, you see a lot of jumps in price, order imbalance, and quoted spread, but you don't see that much in effective spread and turnover. Well, why do we see jumps in quoted spread while we don't see jumps in effective spread? Well, one of the explanations would be that effective spread can be measured only at times of when the trade occurs. So assume that now we have a jump in quoted spread, and the stock becomes really liquid. It could be that investors just don't want to buy the stock anymore, and they just go away from the market. So you don't have any observation for effective spread. Why we don't observe any jump for turnover compared to order imbalance? Well, I guess that the main reason is that turnover doesn't incorporate the direction of the trade, while order imbalance does. Yeah, well, there is no trade. Yeah. So now let's see whether this number that I showed you is big enough. Here the graph looks very similar, but it's a bit different on y-axis. I show how many jumps on average occur per year. Well, if you think that the no jump hypothesis is true, then then your variable should follow just normal distribution. And what we also know about our jumps is that average jump size is around 5 standard deviation. If you just then compute how often there should be a jump of 5 standard deviation at 5-minute frequency, then you will end up with an estimate of one jump that occurs once per 96 years, or 0.01 times per year. What we see in our data is that on average you can get, for instance, for Asia, you have price jumps, negative price jumps of 20 per year, which is much higher than 0.01. So what we want to do next, we want to understand why do we observe jumps in prices. we think about two channels for jump in price to occur. The first one is the lack of liquidity. Assume that there is a large order arriving in the market which doesn't have any informational content. But the market is not perfectly resilient, so it consumes the orders on one side of the limit order book, which artificially would increase the price. It would also increase the bid-ask spread. On the other hand, you can have an informed order that arrived in the market. And then you will have a price jump due to new information that is incorporated through trading on that particular 5-minute interval. So to distinguish between these two channels, we basically have 3 different tests. So first we study simultaneous jumps between price, quantity spread, and order imbalance. Then we go and look at return reversals around jumps in price, assuming that if the jump is due to information reasons, then you should not observe any reversals at all. And next, we also conduct an analysis based on macroeconomic news announcements around the world, and we see how many jumps in price occur around the macroeconomic news announcement. So let's look at simultaneous jumps in price. On this graph, I show how likely it is to get a simultaneous jump in price and quantity spread. So and price and order imbalance. So in the first graph, what is shown there is that suppose like the first, sorry, does it show? Okay. Well, so the first part is, yeah, thank you. So yeah, so the first part, basically what it shows that suppose there is a positive jump in price and a positive jump in quantity spread. How likely is to observe this? And this would be, what I plot here would be the fraction of total positive jumps in price. This would be the fraction of positive jumps in price and quantity spread that occur together relative to total positive jumps in price. Positive negative is then the positive jumps in price and negative jumps in quantity spread, and so on. So what we do observe here is that we don't have any clear patterns in simultaneous jumps between price and quantity spread. So you can't say that, say, for liquidity reason, you would expect that it doesn't matter at which side, what signs the price jump has, but the quantity spread should also always jump positively if there is lack of liquidity. But what you see is that basically any combination of the jumps is equally likely to occur. You can't statistically distinguish between them. If you look at the jumps for price and order imbalance, then you observe a totally different picture. Almost all the time, if jumps in price and order imbalance coincide with the same 5-minute interval, they would coincide with the same sign. So what it means that basically if you have a positive jump in order imbalance, you have a lot of buying pressure, the price will go up. Here, I conduct a statistical test to distinguish between, to show that this fraction that I showed you on the previous graph is actually statistically different from the ones that could realize just by pure chance. So this is like the theoretical probability would be then the probability under dependence assumption. So it's basically just multiplication of a fraction of jumps in price with fraction of jumps in quantity spread. And the empirical probability, it's the actual amount of coincidence that we observe in the data. What we do see here is that clearly jumps in price and order imbalance have a much greater empirical probability than probability under independence assumption. While for quantity spread, it's not that clear, and there are quite few cases when we really observe a significant result of our tests. In other words, there is no relation, at least no consistent relation between jumps in price and liquidity measured by quantity spread, while we observe the jumps in price are quite strongly associated with the jumps in order imbalance of the same sign. So now the next step of the analysis is whether we observe any price reversal after the jump occurs. So you have two panels with positive jumps and negative jumps in price separately. And on x-axis, we have 5-minute intervals. So basically, we look at 1 hour before the price jump and 1 hour after a price jump. This is an average cumulative return across all 12 markets. So what we do observe is basically it doesn't matter whether it's positive or negative jump in price, you don't see any return reversal. And we think that this provide additional evidence that jumps in price are driven primarily by information. The third part of our analysis relates to macroeconomic news announcements. What we did, we went to a database called Econoday and collect the macroeconomic news announcement for the period 2000-2011 for 8 countries: the United States, Canada, Germany, France, UK, Japan, China, and European Monetary Union. And then we document in this table proportion of total amount of jumps in price that occur in for America region around macroeconomic news announcements. So 37% means that 37% of all jumps in price in American region occurs within 1 hour of any of the macroeconomic news announcement coming from these countries. So what we can show is that jumps in America and Europe are quite often associated with macroeconomic news announcement, which is not the case for Asia. But one of the possible reasons could be that simply not enough macroeconomic news announcements occur within opening hours of Asian markets. We haven't yet checked for that how many macroeconomic news announcements just have a chance to occur within opening hours.
Sorry, just clarificatory.
Yep.
Aren't macroeconomic news announcements happening all the time? So anytime there is a jump, if you look back for the recent X minutes, there'll be some announcement.
Yes, there would be a jump if you don't anticipate it, or if suppose you would expect that GDP growth will be 3%, and when the macroeconomic news announcement comes out, it's 3%.
So are you saying that occur 1 hour after a surprise, or is it 1 hour after an announcement?
It's 1 hour after an announcement takes place.
But then, as I said, there are just too many announcements. They're happening all the time.
Yes, we haven't checked whether each particular jump corresponds to a surprise in macroeconomic news announcement. It's one of the in our to-do list, but for now, it's just the timing of macroeconomic news announcement.
You should show us a placebo test where you just invent random times for jumps and find out what this table looks like under the placebo.
Yeah. Thanks. It's very good. The next point that we wanted to address is that we were a bit surprised to find out that quoted spread doesn't jump that often, and that it doesn't relate to jumps in returns or trading activity. So one of the reasons for that could be that actually jumps in market liquidity could be not related to jumps in prices, but joint jumps in market and funding liquidity could actually show up. This motivation comes from Brunemer and Pedersen with their liquidity spirals. So what we look at, we basically look at different proxies for funding liquidity, which is TED spread, default spread, LIBOR rate, short-term interest rates, and bank index returns, and show whether we can find on the days when funding liquidity jumps, whether we can find any relation between our variables. So in this table, I show you the results for TED spread for Asian region. And what we have here is the number of days when there was a jump in funding liquidity joined with either jump in price, quoted spread, or order imbalance. And what we can see is that, well, on aggregate, on average, basically, you don't have jumps in prices, quoted spread, or order imbalance that are accompanied by jumps in funding liquidity. So you can have 1 day for Hong Kong out of, I don't know, at least like 300 or 400 days probably. The only thing is that you can say that for Malaysia, you have a marginally significant outcome of 2 days, but this is still just 2 cases. And you still don't see any relation of these jumps being propagated to another market. What about spillover effects? What we did, we analyzed the Spearman rank correlations for each of our variables separately, and we show that there is spillover for jumps in prices across different countries and for jumps in order imbalance across different countries. But there were no jumps in liquidity. Sorry, there were jumps, but there was no spillover effects for jumps in liquidity. These effects were stronger within the same region and also for developed country pairs. If you look, for example, for spillover effects between United States and Mexico, it's not that high as between United States and Canada, for example. In additional analysis, we also look whether jumps in order imbalance in other countries could matter for jumps in price in different countries. And indeed, it showed up significantly, especially within the same region groups. So to conclude, we think that jumps in prices occur due to new information. We find out that liquidity black holes are isolated events. They're isolated within the market, and also so they don't spill over to other markets, and they also don't affect any other variables in the market. Jumps in price and trading activity could be propagated between markets within the same 5-minute intervals. We believe that these results are quite important for different market participants. For instance, investors should know that there are certain limits to the diversification. For regulators, it's important then to address the problem of shock propagation at a higher frequency, and I assume at much higher frequencies than 1 minute, especially now, than 5 minutes, especially nowadays. But the fact that jumps in prices occur due to new information makes us to think about whether we should regulate these jumps or not, because in the end, we want markets to be efficient, and if jump is a way how the market interprets new information, then probably we should not regulate it. Thank you for your attention.
Thank you, Darya. You have the luxury of having many discussants here. Pradeep.
We have a lot of discussants here. I'll kick off. The few comments in that context. First is that you extensively use the quoted spread and not the effective spread. So it is relevant to appreciate what the quoted spread really is. The quoted spread, as you observe it, is the difference between the best bid and the best offer. It is not really a measure of liquidity because of the fact that it does not represent the liquidity cost of any particular liquidity provider. What represents the cost of a liquidity provider is the effective spread. So the quoted spread could well be zero, and you could even have crossed markets. But the best bid is being provided by somebody who's different from the best ask. So I'm certainly not surprised by the fact that you observe what you observe in relation to jumps in the quoted spread and jumps in prices. There is no reason why they should have a relationship. Yes, the jumps in effective spread are few, but then that is what is relevant if you are looking for jumps in liquidity versus jumps in prices. That's my first comment. Second, you have a jump measure which is a measure which does not take into account direction. So, for example, just as you have variance and you have semi-variance. Semi-variance looks at variance which is in one direction. So, in fact, the first graph that you put up was really more like a flash crash rather than when we think of jumps in finance, we think of a movement in price in one direction. So yes, it will show up in your data as a jump, but then it is it's a flash crash kind of jump and not really a jump in price. So I would suggest that if you are looking for a variable to relate those kind of jumps to, that variable should be something like a depth. Now, you say you have all the orders, you have all the trades. So what is the depth of the market at that time? That is what that will relate to. It should, I don't see any reason why that should, in liquidity terms, relate more to anything else. Now, in relation to the jump measure as measured by some kind of a directional measure, that would be a price jump. And it would be, you could think of relating it to various variables. So saying that the jumps are all based on price and not on liquidity on the basis of the result is potentially, one has to be careful of making that inference. Finally, you relate your thing to funding liquidity, and you use the TED spread or the LIBOR as your measure of funding liquidity. Now, I would say that's first, it is being done at a very high frequency, and I'm not sure whether funding liquidity changes should be relevant at that kind of high frequency. When you think of funding liquidity, we are talking of usually longer periods of time. We are not looking at, okay, there's a crisis of funding liquidity in that 5-minute interval. And in that context, the TED and the LIBOR appear to me to be very coarse measures. And I'm not sure what exactly you're picking up in that context.
All right. Ajay?
So I found this work extremely interesting and extremely valuable. That it is rich with novelties that I think can be usefully applied in many other places, modulo many technical improvements. I have one, so for example, located in the field of liquidity black holes, I have one small thought for what could be done, and it's not narrowly this paper, but potentially another paper. On 13th of September 2008, in the late night after Friday in the US, Lehman filed for bankruptcy. Okay, and I was here in India on the Monday morning that followed, and there was a liquidity collapse here. Okay, the money market choked, and all hell had broken loose on the money market. And while we haven't looked at the evidence yet on the equity market, I would be not at all surprised if there was a complete disruption of arbitrage and market making and so on. That's still work to be done in the future. But it seems to me that there was a very international collapse of the money market, because what was going on was that the money market in the US had collapsed and lots of corporations were short of liquidity. They had money market obligations coming up, and so they were borrowing everywhere in the world to make payments that were due in the US. So what we found was that Indian multinational corporations were scrambling to borrow money in India to meet payments that were due in London and in New York from that Monday onwards. So that generated a liquidity collapse in India. Now, I'm reminded of a paper by Richard Roll in the FAJ in 1988, which is called the International Stock Market Crash of 1987. So it would be interesting to use your data and your thought process, but to carefully drill into the Lehman event and just tell us a story of that one day. I think that one day, the Monday of September 2008, is a very, very interesting and important day. And your data set and your conceptual framework is the right raw material to think about it.
Thank you, Ajay. Any questions? Yes?
Hi, I'm Sargam from FRG, IJDR. So you take a window of 1 hour so that your news can propagate internationally. Will it not be better if we can, broaden that span of the window so that we can better capture the Asian markets and all relative to the US news? Like the way we saw in the presentation, the impact probability on Asian markets was relatively much less. I think it would be much exhaustive if we can broaden the window of that propagation.
I understand what you mean. I think the thing is that for this analysis, what we don't look at any overnight returns. So basically, even if something happened in US before opening an Indian market, even if we extend the window, we just don't include the opening returns there. So the thing is that we just wouldn't see anything. Why we did it is because there was already quite a few papers that studied the effect of the overnight information propagation when one market is still closed. and another market already generated new information. So we decided to limit ourselves only to intraday data. We can broaden the window, but I mean, if Asian market don't have overlap with US, there still will be nothing.
Okay, yeah.
I have just one suggestion. I'm a bit out of date with the literature, but the thing is, I read some time back, there is a paper by Yasin Ait Sahalia on mutually exciting and self-exciting jump processes. So maybe you could use that. So basically he uses a Hawk's process kind of framework to analyze jumps. So I think that you might actually want to take a look at that paper, because I think that was a nice framework to basically look at how jumps propagate. So I think he was not exactly looking at 5 minute, but idea was this spillover, and he looked at similar ideas. So maybe you should take a look at that.
Okay, Pawan.
So basically, what I get out of this paper is markets are becoming more efficient, right? Because instantly the information is being incorporated into prices and they stay at the same level, instead of having a step by step where it's a slow incorporation of information. So your conclusion is markets have become more efficient because all the information is instantly incorporated into prices, right?
I would not say that markets have become more efficient, because I don't compare it through time. So what I say is that for the period from 1996 to 2011, on average, you would see, if there is some kind of extreme news coming out, you would see an instant incorporation. I don't say that, for example, if you would have a regular earnings announcement on a firm, you would also get an instant incorporation.
Not only earnings announcement, but so here is a suggestion. Maybe you can look at the time trend, just looking at how the information is being incorporated. Is it instantaneous as your graph shows? I mean, that looks like, well, as soon as the information comes in, it's instantly incorporated and it stays at the same level, because it's a permanent information. Mm-hmm. If it was temporary, then price will come back to the same level.
See, the definition of jump does not distinguish between information-driven and liquidity-driven, right? So I think there is something about your technology to determine the jump, which is sort of capturing only the information-driven jumps and not the flash crash sort of thing where it comes back.
One suggestion could be to look at the information component, right? I mean, there are information-based liquidity measures, like maybe decomposing spread, looking at adverse selection, or even probability of informed trading, some of those measures, because you have the intraday high-frequency data comparing those. And one another question is, you look at 5 minutes, are those 5-minute snapshots? So you calculate the quoted spread at the end of each 5 minute?
In this case, yes, but we're also considering doing a robustness check for time weighted within the 5 minutes.
Okay, all right, thanks.
I had a couple of points which it may be relevant or not relevant, I don't know. The one is these 5-minute buckets, right? I mean, if you assume that in some markets it takes a longer time, so if you're looking at lagged order imbalance versus like the previous 5-minute order imbalance is affecting the price jumps. So so it may not be contemporaneous, so I don't know whether you've looked at sort of moving the both variables by one lag or a couple of lags.
So what we have done was that we look at each particular day and see whether there were any jumps, say, in order imbalance, preceding jumps in price on that day, and any jumps in order imbalance that would be after the jump in price on that day. And you don't see much. So they either happen
So they all happen simultaneously?
Yeah, either simultaneously or they don't happen.
Oh, I see, okay. So the other thing about the Asian market, where I think you had a lower effect when you have macroeconomic, is that there are a lot of market structure frictions. Like price limits is one example, right? Where there is some of these jumps may not manifest at all because sort of trading is stopped. Mm-hmm. And therefore you don't, as you said earlier about the effective spread, that you don't see trading at all, in which case you can't determine jumps. So maybe that's something that is affecting your Asian market results. And then the last point is, you seem to group these markets based on geography, which seemed, from being having been a trader, it's sort of like the Indian market probably moves a lot closer to the US than Japan. because there's a lot of the money flow being the same. The traders, I think as Ajay was saying, there's a lot of firms which were connected to the US market. So if there's a shock in the US market, it is felt in India. So you may want to consider some sort of FII flows, like the foreign institutional investor flows, as a way to group these markets as opposed to the geography of the markets.
In principle, currently we do analysis for each of 12 markets separately, and just for the sake of presentation, I took averages within the region. And the reason and also why we pick up region grouping is that we don't look at any overnight returns. So we need as much time overlap as possible. And in my setting, I just can't look at Indian market and US market together.
So just one point on, we did a similar exercise in the industry about in 2007 when there was a quant crisis. And so where a bunch of quantitatively driven hedge funds faced a shock, and there the transmission of shock was happening across asset classes. So here you're looking only at equity markets, but we could actually see that the shocks were propagating from the currency market to the bond markets to the equity markets very rapidly, because the same players were participating in all these markets. So I think it's a very interesting study to even look at the connection across markets, across assets.
Definitely, I totally agree with you, but for now it was just the problem of the large data set. We just decided to limit ourselves for equity markets, but for the future, and probably on separate papers, it would be definitely interesting to look at the cross assets.
One more suggestion I have, which is when you're looking at the propagation of shocks and you're looking at a change in a 5-minute interval, you might want to consider looking at something which you can define as more extreme, where that change is persistent across, say, successive 5-minute intervals for, say, an hour or an X period of time, which will represent a persistent shock. That would transmit, I would think that would have much stronger effects. It'll be rarer, but it'll have stronger effects.
Thank you very much. So what we also did, I didn't report it during the presentation, we had a robustness check for 15 minutes relative to the week. So we defined whether there was a jump during a week and see at which 15 minutes it happened, and the same for 60 minutes. So, and indeed the results are, the jumps are more rare, but they tend to propagate a bit more stronger than 5-minute jumps. That's true.
So in industry, people rarely use time buckets, like 5 minutes or 15 minutes, which is very arbitrary. So people use volume time. So something that it's not come to academic circles yet, but industry people always look at what is the time it takes for 100,000 shares to move, which is quite different, because then you can compare across stocks, you can compare across markets. So I think the whole literature is not, it's still focused on 5-minute, 10-minute sort of thing, which seems arbitrary.
Actually, that is not true. A lot of people look at actually volume time bucketing in academics also. And there are papers by Maureen O'Hara and some co-authors who have looked at this.
I have a question on your aggregation policy. Basically, you're looking at aggregate return, right? You just add. But I was just worried about throwing away data, because one of the things that struck me when I was listening to Pradeep's question about the propagation, if you look at the actual stocks themselves, for example, macroeconomic shock happens in the US, maybe oil stocks are reacting, and then you find electricity stocks are reacting in Europe. I'm finding it hard to believe there'll be a kind of economic explanation for why the shock is propagating. So drilling down into the actual stocks which are moving may help you tease out a more economic mechanism, right? It can't be that you've got firms in completely different industries, and just because you're aggregating, you just see it jump together.
Yeah. Thanks.
Sorry. I see you repeatedly mentioned Branimir and Peterson's paper. For that paper, if I remember correctly, it more talks about the bank, a particular bank or particular firms that the lower value of MBS leads to more bank withdrawals, then more bank withdrawals leads to lower value of MBS. I'm wondering how this can be applied to the whole market in the sense that there should be like a spiral as well, that a decrease of price leads to a decrease of liquidity, and the decrease of liquidity, so the funding liquidity leads to the price decline. So that's, I think that's the mechanism, but here it's more like a 5 minutes phenomenon. So how that paper actually links to this paper, because you frequently cited that paper?
From my perspective, this basically what Brunner and Patterson shows that in certain cases liquidity would matter, and would basically be a source of financial crisis.
But that's for a particular bank, right?
No, it's not about bank run. I'm talking about it was a paper when basically you have a market maker who has a shock, a funding shock, right?
So I'm wondering how this can be applied to the whole market.
So for the whole market, again, like in the recent crisis, you just, so there's a money market run or something. You just can't get money anymore, or you can't short sell the stock anymore. So it applies for the whole market. The whole market will get so-called funding shock.
All right. Okay.
And then you will have this similar mechanism, but on a market basis. You can think about it that each individual market maker runs in exactly the same trouble as Brunner and Patterson described.
Okay, thank you.
Hi, so I am Anurag. I am from FRG. So I had two suggestions. So the spillover effects that you mentioned, those were in two categories. One was in region. There was a correlation between region, and one was in development band. As in the countries in the development band, they had similar jumps in the same amount of time. So what I wanted, one was the one point that I wanted to make is quite similar to what Venki mentioned, is it would be interesting to know how much a market in a country is exposed to some other market, and then try to correlate between the two, as in, say, if India is exposed more to Japan or say Singapore, so we can have that can be a factor in the jumps that you have in these two markets. And one another interesting thing that that we would like to know is stocks in some specific industry groups, say minerals or consultancy companies, do they also show similar kind of behavior in the
So regarding your first comment, again, what basically was reported here was an aggregate results by region, but actually it's also everything is by country. So basically what we have a pyramid correlation of Indian market with Japanese market. And just it's a bit inconvenient to present a 12 by 12 matrix on a slide. So. And indeed, you have, for some countries, you have a much stronger correlation than for the others one, just because, I mean, if you talk about countries that are members of European Monetary Union, you are much likely to see a higher correlation between them than if you're talking about other countries. Thanks.
Thank you, Darya. Thank you very much to everyone. So Susan, you want to?
I know the discussant has landed, but he's not here yet, so I think that we shall wind this session down.